All right, so I've hit the recording button. Welcome everyone. My name is Glenn Thompson, as you see on your screen, and I've been consulting and working as a mentor with Pacific Trading Academy since the beginning, going on 15 years now. If you'd like to find out more about what I do in greater detail, you can reach me at least indirectly by contacting our management staff and team at Pacific Trading Academy. Our toll-free number, as you see, is 800-339-8588. You can also access the site, our website, www.pacifictradingacademy.com. The emergence of the metals. When they asked me last week to select a title, about a year ago, I think it was last June or the end of June, beginning of July, I did a presentation. I think the title was something, the takeoff of silver or something to that effect. It did move up. Silver and metals and gold and the precious metal sector in general at that point about a year ago did move up. Nowhere near the magnitude of the move that at the time I had projected based on long-term, the 60-year cycle in particular, and other factors a year ago that I thought would come together and serve as to lift metals prices. So I thought it was appropriate at this juncture, since I haven't talked about the precious metal sector in about a year, to kind of revisit what's going on and what I expect to occur. It's not necessarily the results of my analysis from what I just looked at, gold and silver in particular, are not suggesting necessarily a big major bull market. The beauty of speculation is we can make money regardless of the direction of the underlying instrument. But I do have some specific pieces of information, other areas I'm not clear on, so I'll kind of point that out to you where I have greater confidence for how I expect the markets to move. Just one quick note on the before I start. Peter Newman, and then I think the final slide, is the person who handles all the contractual arrangements in the business. He's our director of admissions. So if you have questions and would like to find out more about the specifics of the type of analysis and things I do, you would ask for Peter Newman, and he might just kind of serve as a liaison in that respect. Also, if you have questions, you can write them in the area on your screen on the right side, and then I'll check from time to time. If not, today's presentation should be fairly succinct and pretty quick. I normally go over an hour. Hopefully today I'll keep it within the hour. So on that note, let's proceed. And again, if you have questions on an ongoing basis, if they're pretty straightforward, I'll address them as we proceed. I got to get a new picture. Anyway, timing should always take precedence over price. This is just kind of a hallmark. I typically put this in every other presentation to let you know that I incorporate market timing in my analysis. Let me elaborate on that because I typically just gloss over that. I'm a technician, so I look at charts and I work on the premise that all of the information that's in the world, regardless of its origin or type, ultimately is discounted in the price. So price trumps even time. The importance and the significance of what this slide is conveying is that I believe in order to gain and acquire a sense of understanding as to why a market, be it gold, silver, or a soybean, from one extreme to another, is doing what it's doing, why we're seeing the particular type of price action we see, is correlated very definitely. There's a large body of evidence to suggest a high degree of correlation between certain amounts of time elapsed and what the market does, changes in price action. So yes, price always is an indication of the reality of what's at hand, the systems and the financial markets we're studying. In order to acquire or to become more understanding and have a greater degree of comprehension as to why it is a market's doing, I believe time is the critical component. And so I place a lot of emphasis on that, at least equal emphasis to my time or my price analysis. The next two slides, this is the big picture. This is a long-term monthly chart of gold, continuation gold chart. And I think I could end the presentation today after this slide and the next slide. because it shows kind of from a price standpoint where we are. I've kind of got a tentative wave count. This is an Elliott picture here. This is the big move up. You know, okay, look at the calendar from 1991. You can see this period of what I call surf, or just sideways kind of a C, a quiet C, more or less channeling sideways. And then you had in more or less between 2001 and 2003 a blast off, a takeoff to the high in 2011. Since 2011, and the same chart you'll see in the next slide is pretty similar to gold and similar structure and price geometry. I can make out a potential a description in the context of Elliott wave in terms of what has happened since that high back in 2011. But this is a long-term view. This purple or lavender line is open interest. The vertical bars are volume. Down here is a picture of the commitment of traders report. The red line is what's important relative to the blue. The red line is commercial activity. The blue is the small traders, small specs, as they say, and the green line is the funds, primarily large institutional money. But here's the important point I want you to extract from this chart in terms of a macro picture of what I expect has happened in gold and what the past through the present tells me. If I project it forward, I can expect. This is a tentative wave count, 1, 2, 3, this little triangular formation. Those of you who understand Elliott know that's typical of fourth. And so I think the moves down we've seen recently in the last few months are part and parcel to the formation of a fifth wave. By the way, for those of you who say may not be conversant in any particular model or understanding, stop me, ask a question. The purpose of today's presentation is not to delve into a particular indicator or relationship or mechanical feature of market behavior or interaction between say an indicator and the price action, but rather to just present a big picture overview of what I expect metals, gold and silver in particular, to do. Sometimes the so-called quote-unquote white metals, platinum, palladium, etc., are decorrelated in their price motion relative to the standard precious metals, gold and silver. But so I want to focus. Everything I'm saying today is really specific to gold, just gold and silver. It might apply to platinum or palladium, but I can't assume that. So my research that I did in preparation for today is primarily specific to gold and silver. So here on this count, on this description, it would expect further declines in order to complete the formation of a fifth wave. And then you'd expect a turn or a terminal point. Let's see. Okay. Excellent. I just want to make sure. When I did a presentation a week or I guess 2 weeks ago, someone said the audio was a problem, so I want to make sure you guys can hear me. And I don't want to go too far without a little check. Okay. Can you guys hear, just to make sure? Okay. Very good, thanks. All right, here's the important feature I want you to see and what's going on, I think, in my interpretation in gold. If you look at the entire move up, anywhere, and I don't have the exact, I'm looking at sheets of paper on my work area here where I did a host of arithmetic computations. This is simple. Just take the range from the bottom here up to the top, and I don't have the exact numbers. I think it was 1661 and a half, $1,661. That's basically the range. We were down. You can see we're down here at 200 or between $200 and $300, and we're up here over $1,900. So we're talking about between a $1,600 and $1,700 range. And I did some standard fib ratio analysis, the degrees of retracement. Here's what's interesting. Just about 15 minutes ago, I checked the most recent price of gold basis the August contract, August gold, trading at 1095 and change, 1095.60. So the 50% retracement of this entire multi-year range works out to this number, 1091. So we're very close. I actually printed this chart out in order to create the slide presentation yesterday. So at that time, at whatever time I did, it was at 1094 and 80. So just under 1095. We moved up a little bit today. Curious, and I'll come back to that, in light of what the Fed announcement, the biggest piece of fundamental news, I guess, for this week was the release of the notes of the FOMC meeting. And I'll come back to the interplay in my take on that in terms of current Fed posturing and policy and what I expect and how I expect it will impact different sectors. But here's what I think is at play here. I think the market may hesitate because, as it typically would be expected, at an important zone of in this case, since the market's declining, zone of projected underlying support. From the standpoint of Fibonacci retracement analysis, 38.2, 50, 61.8 are the three most central and critical and important degrees of retracement. Thank you, JAC, for agreeing there. Yes, and I guess on the technicals, making sure you can hear. All right, so I think that's where we are. We're very close. The market's hovering in and around this area that would constitute about a 50% retracement of the long-term, multi-year move up. And I think that brings us to the present. I had worked out other levels, the 38, the 50, the 61, the 78 point, the different fib levels. But 1091 precisely corresponds to about a 50% range or degree of retracement of this entire move up. There's another way of looking at this, another wave description. You could look at everything from this bottom here back in 2001 or 2000, whatever the bottom is, end of 99, 2000, all the way up to the top in 2011 as a 1, 2, 3, 4, 5 pattern, and everything that has ensued price-wise, the decline is the ABC correction and a broader paradigm of Elliott. So you might say that this is the A, this is the B somewhere in here, and then we're now in a C. However you want to look at it, it accounts for the type of price action. There are two plausible descriptions. Theoretically, anytime you reach the end of a fifth wave, you expect a trend reversal. It's a terminal point. It is the ultimate focal point of Elliott, the Elliott model, to determine when a market has achieved the end of a particular fifth wave of a certain degree. Because if you can do that with a degree of confidence, the market will reverse, and it certainly has. Whether that reversal is due to another generic bear market, as I have indicated in this wave count on this slide, or it's just a correction of the preceding cycle, ABC, that's a harder question to address. It's an important one, but it's harder. So in either case, whether I call this A, this B, this C, or if I call it 1, 2, 3, 4, and 5, apart from that, a completely different but integrated form of analysis is I see the magnitude as stated as a percentage of retracement, 50%. That's where we are in gold right now. Let's move on to the next slide. Similar, just same analysis. Basically, you can see similar, this is silver. This is a long-term, same, 1991 through the present chart of silver. More or less same structure. It's not exactly a replica of the gold, but gold and silver prices tend to have about a 70% correlation. So they tend to track similarly 70% of the time, and that's due to their tendency to respond to any type of information in a similar way. And I have the corresponding information and open interest, the other factors that more finely describe what's going on. Open interest is this lavender line volume, and then the commitment of traders data long term. This is on a monthly chart in silver. Here, curiously, as a percentage of retracement of the entire move up, again going back to the bottom in 2001 all the way up to the top in 2011, 1, 2, 3, this triangular obvious fourth. And by the way, that's one of the reasons why I marked and labeled these two charts as a new generic bear market as opposed to an ABC, a set of 5 waves, because of this triangular kind of serpentine type structure. That's very typical of fourth wave type market behavior, again within a context of the Elliott principle. So that's why I decided. But alternatively, someone could look at that and say that everything from the peak in both gold and silver, from the top that formed in 2011 through where we are, could just be a long-term multi-year ABC correction. This would be the A, this would be the B, and we could be in a C. In either case, the type of price act, the returns we're seeing in price action are the same. We have two plausible, highly probable scenarios, or just ways of addressing or describing the market given a wave count. It's curious because they might reconcile, and I think that's gives me confidence that I'm at least partially on the right track here. Okay, so it turns out that the amount of the degree of decline in silver prices from the top of 2011 to where we are constitutes, okay, when I just checked 10-15 minutes ago, the price of silver, 1477. This is printed out yesterday. We were at 1466. Curiously, folks, just want to make make an excursion into the real world for 1 second before, and I'll come back to this chart and go back to theory. But yesterday I went long in silver at on average price about $14.30 per ounce. So we're trading. This was printed out yesterday after I established my long position in silver, and I'll tell you why in a few minutes based on the other slides. But we are long on average, and the people that follow my signals and so forth, on average in the underlying futures contract, September silver, 1430, let's say, on average price. This was at yesterday. At some point later, it had already moved up. Again, about 15-20 minutes ago, the price of silver was at 1477. It had an intraday high so far, 1490, just under 15. So far so good in terms of that real world trade that we got into yesterday. Here's what part of the reason why we are doing that, and what it's based on my theoretical projections here. The amount of pullback or decline in this case for silver is greater than the one for gold. Gold was at a 50%, but here we are at 1466, and this 1341 is my theoretical level for which, if the market had dropped down to, would be about a 61.8 fib level. So we didn't quite get there, but we're very close. In other words, the reason the market, I believe, is hovering at the levels in the range where it is right now is it's feeling the impact of the 61.8 Fibonacci retracement level. And so I think that to a large extent gives me some means of stating the state of this system, of this very complicated dynamic system. I know at least the reason it has declined and is kind of in this range for the last few sessions is because it is gravitating to the 61.8 Fibonacci level rather than some alternatively random specific price or a specific range of prices. I think we're very proximal. You know, the current level 1466, or right now 1477. It moved up about 10 cents from yesterday, 10, 11 cents currently but it's still relatively close given the 4-year span. That's within a very high degree of precision. It's gravitating to the 61 fib level, right? So whenever a market gets close to any degree, any level of support or resistance, one of two things always occur. It's either going to respect it, if it's support, if a market's declining and it's coming ever closer to a zone of support, it's either going to bounce off of that support, as we would expect. Support would have a greater than average propensity to impute to the price a degree of a carom or a rebound, or the market will slice cleanly through it will be oblivious, and in which case all of the variables isolated, you can expect the market will travel along that line of trajectory until it achieves the next lower zone of support in that ladder or degree of support or spectrum of support, or if it's rising, the same thing, just in reverse. All right. So that's the big picture for gold and silver. Again, structurally, and the spatial arrangements and the geometry is pretty similar, although the magnitude in absolute terms for silver amount of retracement is a percentage is greater than it is for gold. But I think in either case. So if we're working on the premise that one of those two things is going to happen, either in both gold and silver. Either the market's going to move up from here because it's responding to, in the case of gold, let me go back to the previous slide, the 50% Fibonacci degree of retracement, and I can expect a move up, or it's going to break through and come down and maybe go on down and test the 61.8 degree of retracement. And for silver, same idea, just it's kind of further along in its degree of retracement. Either the market in silver will respect this level at 61.8 and bounce up, as I kind of expect it will, or it's a fake out and we're going to move up and then turn around and go and break down below 61.8, in which case the market, all of the variables isolated, can be expected to continue to drop into the next level of support, which might very well be the 78.6 fib level. So let me just state, given these two slides, My projections for the moment are for the market to at least temporarily, and I'll kind of define that in a second, respect the two, in the case of gold, the 50% zone of retracement, in the case of silver, the 62 or 61.8 zone. And as such, I am right now, in the short term at least, bullish both in the metals. So that's my qualitative projection. I expect appreciation in silver and gold prices for the short term at least. And short term at least, well, let me explain why. I think the next slides. Are you guys still here? I want to make sure before I go too deeper you can hear. Are you still with me? Good. Okay. Great. Excellent. It's because now I'm going to present some of my logic and rationale as to why I have my qualitative projection and why I'm bullish the metals right now. Well, yeah, let me just move on to the next slide. You'll see. Time factors. Okay, this is just, I forgot I put this in here as just a little more context. This is a slide that I put in my webinar a year ago when it was talking about my projection for gold and silver to move up significantly. There's a 60-year cycle. Gold and silver prices, let me just so you can see this clearly, had a major bottom. Gold prices bottomed December 1953. Wow, I wasn't even around then. I didn't come in until another little more than 3 years later. And silver bottom, aging myself, silver bottom, I still wasn't around in the bottom in silver, those long-term bottoms. And then historically, in both cases, both markets moved up for a 2-year period. A year ago, remember, this was, I think, at the end of June or first part of, or somewhere in July. It was pretty much almost a year ago when I was talking and sharing my ideas on my projections for the metals. I expected a big bull market to ensue, due in part due to this long-term 60-year cycle, and I place a lot of importance on that, and how historically the market moved for the next 2 years. It moved up. And as such, I projected a top for both markets somewhere between into the middle to the end of 2015. So we're kind of right here. That did not happen. This stuff here, just disregard. It's the other stuff. At the time, a year ago, this was some ancillary bits and pieces of cyclical information that I thought would support my projection. But the most important thing, the reason I'm presenting this is to kind of give you a sense of my thought a year ago and what I was projecting for gold and silver, and let's see what actually happened and compare it. I had the right idea, and in fact we did move up, but just not anywhere to near the extent, the magnitude of the price change was not as big as I'd anticipated. Nevertheless, I was correct directionally, just way out of the ballpark in terms of the extent of the move. But at least the direction was, to a large extent, based on the application and looking back and seeing historically what had happened when the market had achieved major bottoms, and looking at the next 2 years of activity and projecting a similar type of price action moving us forward to closer to the present. All right, this is a slide that I presented kind of together with the preceding slide to illustrate what was going on. This is back in June of 2013. This brings us through a year ago, last June, and probably right around the time you can see where we were into, I guess I was presenting this at the end of June or first part of July of last summer. So it's about a year ago. And I thought that from a wave standpoint, this was your wave one. And all of this move down into the middle of last summer, basically a year ago, was a correction wave two. And I was expecting wave three, May of this year, to mark the end from a time standpoint. By the way, how did I get that? Well, this is what this red arrow refers to theoretically as a timing mechanism embedded in the Elliott model. However long third waves take to form, they should not exceed the sum run time of formation from the start of wave one through the end of wave two. That was 337 days. So that's I'm sure that's how I came up with. I mean, it's not, but it could be less. It could be any time less. It just 70% of the time third waves do not exceed a run time for the summation of however long it took from the start of wave one through the end of wave two. So that enabled me to project a theoretical time marker or point beyond which I would not have expected again, a year ago, that third wave to take in order to complete its formation. All right. That's what I was looking at a year ago to kind of give you a sense. Here's the date, June 5. Remember this date because it'll tie in with the next slide. 6 would bring us fast forward to the present. June, I was saying that that first week in June essentially marked the end of what I thought was a long-term kind of correction and would commensurately mark the onset of what would be the major move up in metals prices in order to form wave 3. And again, it started, I was expecting that that had commenced in more or less the first week of June. So I guess it was the week of June 5. So the next slide brings us to the present. This is daily gold. Oh, I just realized it's kind of chopped off here. What you don't see on the left side here is at a bottom. I should have, you know, when I proofread this, it showed I had a time marker here. There was a bottom kind of right around in here on the very left side, but somehow it got cropped off. But it shows the date. There was an important bottom. This is daily gold. This is the August gold contract, and you can see that there was an important bottom, June 2nd. The June 2nd bottom, and again, this is a year ago. It's just didn't make it onto the screen. On one of my proofs, it did. Why it didn't come into this particular file? There is a bottom working its way up to this top. This was the top right here that the preceding slide was projecting. I was projecting a top more or less to come in with an end date no later than May of this year. And it started the big move up, what I thought or would have labeled in my thinking at that time what would have been the formation of a third wave. June, last summer, June, again, is a data point which somehow didn't make it onto this slide. But you can see August here, somehow or other, over here, the actual bottom came in on June 2nd on this particular contract. And this was the top that I was expecting. And both from a price standpoint, it was significantly lower than what I had projected. And now, here's not, you know, the preceding slide time point of May of 2015, come over here, this is where we are. It is, curiously, we did form a top in May 18, but certainly that's not the particular top. It's not the highest top even on this screen for gold. But here was the top, essentially, that I was projecting. It happens to be the highest point on the recent contract, the current contract, the front month in gold prices, August gold, right here. It is nowhere near, you can see. I also noticed my price axis here is not showing, but you can see however high it was not proportional from a Fibonacci standpoint. It's not the type of move that I was in terms of quantitative degree and extent. But it did qualitatively move in the direction that I did, just not to as far as I thought it would go. So this top right here marks the end of the move that I was predicting or forecasting a year ago. But again, it failed to reach the summit to which, in terms of a price that I thought it would, and it came in much quicker. That's typical. That's very third wave-like. The fact that it didn't extend over to where we are a few months ago in May is not problematic. That's very typical. Third waves tend to, if nothing else, be very high velocity portions of a market cycle. What is an indication to me that it was not the big bull market that I might have been expecting theoretically is just the price. It wasn't commensurate with the preceding wave one. All right. Nevertheless, here was the top of that actually came in, and then we had some pullback. And these are important dates that I want you to see, bringing us more proximal to the present. January 21 top, beginning of this year, retracement. April 6. This is the situation in gold. This is also an important date, March 26. March 26 was more prominent in the silver chart, as the next slide will indicate, but essentially these are correlated. This top actually came in gold. It's a little more obvious here, a little more salient. April 6, this is the March 26 top, and then more recently a significant top, May 18. Curiously enough, this May 18 top in metals, gold and silver, correlates very strongly. We had major tops in the major turning points in bonds and in the financials. May 19th in particular was a critical top in the stock market and a critical turn point in the bond and the interest rate sector. So this date is of great importance because it correlates and ties in motion and activity in other financial correlated markets, i.e. the stock sector, as evidenced by any of the major indices, the Dow and S&P or Russell or NASDAQ, and the bond market. May 19th was the actual date, so it correlated very greatly. You know, there are all sorts of relationships. I want to get off on a slight tangent. I'll come back here. Someone asked me yesterday when we were mulling over the possibility of what we thought was going to happen, what the Fed action, if anything, what was the announcement going to be today? I was trying to anticipate what would come, just playing a kind of a mental game in my thought process with what was the Fed, what was Janet Yellen going to say today in terms of the economy. Curiously enough, for the last couple of weeks, I've been getting all sorts of negative, you know, or less than optimal data on labor, housing, you know, some of the fundamental stuff that we look to ostensibly to try and figure out how we expect various factions of our economy will move. And the big question, I guess, going on for, I don't know how important it is, but it's central to the markets, and it's a big news in terms of the media. You know, at what point and to what extent will the central bank, our Federal Reserve, raise interest rates? Will it be in September? You know, 5 months ago it was, will it be in the summer? Now where we are coming into the end of July, August next week, will the Fed raise rates between now and September, or are they going to delay? Well, Janet Yellen the central bank's narrative tends to be equivocal. They tend to give themselves always an out, so it's very difficult. I suggest, I think they're doing the right thing, and I don't want to get off on too much of a tangent, but here, the reason I even raised this as a point is financial markets, and in particular metals, respond to this, either directly or indirectly through the interconnected way by which, or reaction that we see in the equity sector, or say in a broad market index like the S&P, and or interest rates, the Treasury instruments. So these are important points to raise in a broader consideration of how I expect metals to move. But here, these are some important dates that might mark some smaller scale wave structure. But I want you to see here, this is a little triangular pattern. This vertical line, okay, these are dates. This date, these are just obvious turning points, some of which I might have projected via my timing model, some of which I may not have. This is important, July 31st, and unfortunately, I don't know how this happened, because in the testing, this is a theoretical time target that which happens to be 2 days from now. That's this Friday, July 31st. This vertical blue line here that you see is corresponding to the date of July 31st, the last day in this month. What you don't see on the screen, to my chagrin, is my subsequent projected time target that I feel will be relevant for both gold and silver, which is, and it's a curious date, it is what it is, I don't plan these things, I don't know, it's so curious, it does ask or beg the question, is it merely coincidence? But September 11th. It's an obvious date historically in the US and worldwide, I guess. But these are my two next dates that I have projected, the significance of which is it's an indication where I expect change. One type of change is clearly an outright 180-degree change of reversal, where a market stops trending down and starts to go up, or vice versa. I start the analysis in a very simplistic manner. I ask myself, what is the market doing at the point it arrives at any projected time target? If I have confidence in my time target, I expect the market initially, my immediate expectancy is to expect an outright reversal, where if it's going down, it reverses and goes up, or vice versa. So, if, again, 2 days from now is my time target, and then all things being equal, that's a phrase I could put on a record and play over, it's a broken record. My next projected time target, again, it's not on the screen, why I don't know, but I'm disappointed you don't see it, but take my word, September 11th. So that's going to be, you know, I expect the market more or less will move overall from one time point to another, and the time targets more or less establish the rotation of price action, up to down, down to up. There's an alternating kind of flow of price motion. So if that's the case, the question presents, what is the market doing, or has it been doing through the present at least, lately? Well, clearly, since an obvious turning point, the last one, May 18th, here, we've been coming down. Now notice this was this bottom right here, the lowest point on your screen, and that still is in effect even through this moment, right as of 15 minutes, unless something dramatic happened since I've been on with you with this presentation. That's the bottom that came in last Friday, which was July 24. So it might be that the bottom is in prices, and my projected time point of July 31st was a week late. Yeah, it can happen. I'm not always perfectly precise, or the accuracy is not always perfect, but more or less, you know, it came within a week, considering how far we've been moving since the third week in May lower in gold prices. And we have this triangular pattern here. So I don't know if the bottom, the intraday bottom, and that came in a week last Friday is an aberration, is an outlier, or if we're going to go, fall into by the end of this week. It remains to be seen. My guess right now, if you press me, is that bottom is this bottom is connected to my theoretical, and it just came in a week earlier than my projection. That's my guess right now. We'll see. At whatever point, when you have confidence that the price is corresponding to the time point, I would expect that the market will move relatively uninterrupted into the next time target, which is 9/11, September 11. So we'll see, get an idea of that. All right, let's move on to the next slide. This is the same structure that I have for the silver chart, same dates, January 21st, March 26, May 18. This part of the right side of the screen got kind of chopped off here, but these show the important dates. And my feeling was, you can't, I don't know how or what happened to that price action in silver there, but on the right side. But it's essentially very similar structure. We don't have the triangular pattern that we have in the gold chart. But essentially, I'm placing my bet on the idea that the time target that I projected for this Friday, the end of July, either will come in, we may get another pullback in silver here, even though I've established my long position, or it's already in. This position here actually was a few weeks ago. That bottom right there coming into the 38.2 Fibonacci level, if you can see that, is not the same bottom. That's earlier than the bottom that came in last Friday in the gold chart. Let's go back there. Yeah. So I'm expecting that at least a temporary bottom is in, and this is why I said a few minutes ago, for the short term, I am bullish. Does this mean that now here's where the uncertainty is, where there's some gray area. I don't know that this is just, we're still in the midst of forming this long-term fifth wave down, or is this just an internal subdivision, a fluctuation, a move up? Here's my thought, to be a little more precise in terms of trying to make sense of the data that I do have a lot of confidence in. I do expect, again, if the next time target, July 31st, 2 days from today, and the one after that, September 11. By the way, there may be interim time targets. Those are the two dates that the particular array of tools that I have confidence in and then have utilized and suggest to me a high probability for change to occur. So that's what I've got to go on. I've got to go on how the market is moving in the context of the time points for which I have confidence. And that would suggest we might move up into the next time point, at which point I would expect a higher than average probability for change to occur. So let's see, folks. But right now, just based on the current price action, and as Gann would say, as it squares or meets up with time, when its time is run out for a certain type of behavior, I expect a corresponding change. In this case, I expect more than likely it to reverse. How does that reconcile or not with the accumulation or aggregate of all the other information? Again, the important information that came out this week, just earlier today, is the Fed's response. The Fed basically on the surface, and I'll come to your question, Sheth, in a second. I see there have been, and VJ, there's some questions here I'll talk to, but let me just finish this one statement here. The Fed basically said today that they're seeing positive signs of growth. They're seeing strength in the job sector, in a decrease in the jobless reports, and so forth. They're seeing some strength in the housing sector. I am completely, I won't say aghast at that, because for the last 2 weeks I've been seeing various reports about the weakness inherent in housing for all sorts of reasons. It's saying it's seasonal. There's some aberrations that normally we would have expected housing based on the 7-year cycle to increase. So all of a sudden the Fed comes out today and says we're seeing some indications of strength in both labor and housing. I'm not quite sure what to make of this. My best internal sense is to don't put too much emphasis on it. It's almost, they're setting, that's an indication so that they can make the pronouncement, aha, there is a good chance we will raise interest rates in September or between now or not later than September, or at least this year. It fluctuates. I don't, this is why I don't, you can't make projections based on any one piece of information. We look and see where you have the greatest amount of probable connections and agreements and alignments. But certainly, and curiously, when I was discussing this yesterday with the person who was asking me what are my thoughts and if the Fed should raise rates, isn't there a negative correlation with stocks? In other words, when interest rates go up, borrowing costs go up for corporate America and stock markets come down. Yeah, a relationship is good insofar and only as long as it's good. Stock market rallied today on the news. So to that extent, a relationship is complicated. It's only as good when it is good. One would have thought the knee-jerk response of equity, of stocks in general, as evidenced and reflected by the broader stock markets, the S&P and the Dow and the NASDAQ and the Russell, etc., would have fallen today in response to a greater, a pronouncement by the Fed that there is a X%, a better than average chance, let's say, that they're going to raise rates sooner rather than later. But no, the market rallied. So we can't place too much or attach too much importance on any one piece of information. You tend to, or I think the good analytical policy is to place your greatest amount of significance where you see a preponderance, where you see a pool of agreement, or what we call convergence, where very, very different relationships, in spite of their intrinsic differences, tend to support one another, is where I'm going to tend to focus and have my greatest amount of confidence, and see if I see price action that's consistent with that or not. Okay, let me take a time out here and see. Someone's saying seasonality for gold and silver is around the corner from August. Yes, there is a seasonal component. Seasonality is a type of timing. It's an indication, or it's a sense that year in and year out, certain periods of time or segments in a calendar year, a particular market or market moves in a certain way. And so it is a form of timing that I take a look at, yes. Okay. My other scenario is we've got we've got a planetary cycle coming in this Friday that it is part of the reason why I'm projecting. It's not the only reason. I've got some geometric projection time targeting or models that indicate this Friday, but we've also got a planetary cycle of importance this Friday. I've also got some evidence suggesting for the stock market. My next important time target for stocks is August 19, and after that for stocks, September 22nd. So the reason that I'm mentioning that, even though this webinar in particular is not specific to the U.S. stock sector or equity sector, due to intermarket relations, I want to point that out. August 19 is the next point. So overall, I'm bullish on stocks between now and August 19, essentially. I'm not saying the market is going to make a beeline straight up, but I do expect we're going to break into new highs overall before we have a major correction or bear market. If that scenario holds any weight, and if we begin to see that, it's quite possible. Now, this is more conjecture, that we might see an end of them. I got to emphasize this. As we get closer and closer, it's easier to acquire or take on more confidence in any projection. I think as we move into the fall, we might see more, that September 22nd, which might, if it does, be close enough of a correlation to, in the stocks, 922, and remember my next time target for the metals, 911. Okay, so 11 days of difference, but I wonder for our purposes, are they basically one and the same? So what I'm saying is I might expect moves, if the stock market tops out in the third week or so of the fall, September, that might curiously correspond with an important bottom in metals. And that might be mark the onset of a major thrust upward in metal prices. Now, curious, because I said I'm expecting short-term metal prices to move up sooner, before September, from this, from this Friday, July 31st, the end of July, this current month. That's 2 days from now. I've already established, I put some of my money where my quote-unquote mouth is, so to speak. What can this mean? It brings up the broader interpretation we should all think about whenever an analyst or a guru, if you're watching a financial network program and they talk about a change that they have projected or a trend reversal. Anyone, Gann, Robert Krauss, any of the great people from years gone by in the early Robert Miner, anyone that does market timing, J.P. Morgan, to drop a name, any and all of these analysts that do timing, and I'm certainly one of those analysts that does that, will tell you whenever you're talking about a date and time that you've projected to which you expect a market will hew to and be sensitive and respond to, you've got to take into account, or you've got to broaden your definition to incorporate not just the outright trend reversal where a market forms a top or a bottom, but it can be, there's an alternate complementary type of adjustment that a market's, it's as if the market can switch gears. You more or less are moving in the same direction, albeit at a different clip or angle. The velocity of the trend may change. It moves into a different neighborhood or a different type of behavior such that the market motion acquires different attributes. It shifts. Often this is preceded by gaps and things like that. Not always, but sometimes. So it's quite possible we might see what might be the first leg of a bull market, wave one, if we put it into an Elliott context, beginning, commensurate with my projected time point of this Friday, July 31st. And then it might, maybe in 2 or 3 weeks, maybe by mid to third week of next month, August, form a top. The top might correspond by pure conjecture with a wave one. We may see a pullback into my subsequent time target somewhere corresponding to the 9/11 date particular to the metals, and or the 9/22 date particular that I've projected for stocks, or not. But that's a possible scenario. And then we might move up into the third week or so of September, forming a top in stocks, and then we might continue moving higher in metals. Because if we see a major top in equities, and I'm just thinking about a possible real-world fundamental catalyst that would serve to be a trigger event for launching what would be maybe a third wave, the bull market, a generic bull market in the precious metals. What type of correlated fundamental events would be consistent with that? And I'm not sure, but it can be a host of different types of things generically. But there's the other possibility we could just continue, start to move up in gold and silver prices, say from right now, corresponding to my time target for this Friday, that is the theoretical date, which may or may not have come in. Again, in silver, we saw the bottom a week last Friday, and that might have already begun. And it might, continue to move into my next time target for the metals, September 11. Instead of the September 11 time point marking a top, it could mean that the market maybe takes a rest. It consolidates, trends sideways, maybe it gaps, and continues more or less trending higher in what would be the third of a third. It might be the internal strongest portion of what would be considered, in retrospect at that point, a generic bona fide bull market for metals, especially to the extent we see calamitous issues occurring in our equity sector, problematic issues. I don't know what it would be. The other factors in the world, obviously, for the last 6 months, situation between IMF and Europe and Greece in particular, and the situation in Asia, specifically in the China growth sector, the Shanghai stock market, back and forth in measures that they're taking. So there's the degree of complexity, especially on the fundamental front, is mind-boggling. This is why I don't start there. I just look and I try and simplify this by virtue of some models that have that capacity. Which brings a curious side note, folks. philosophically, and when I start to reflect on the best way to do analysis and try and get some edge, because the trader in me is always looking for edge. Those of you who are, I've done seminars and webinars on the mathematics of analysis. And I'm going to bring up a concept, the Sierpinski Triangle. Those of you who are familiar with it, who have maybe a mathematical background, great. If you aren't, don't worry about it. It's not critical. What's important is that I have thought for a number of years that its order is more readily established than is randomness. How difficult is it to be random? And the Sierpinski triangle, which is essentially a triangular structure, and imagine the 3 points of a triangle. You have a point, 3 points. And then inside of that structure, that geometrical polygon, if you would, you just randomly drew a dot. But each one of the 3 points marking the points of the triangle was an ordered pair. One point is 1, 2, one is 2, 3, or excuse me, 3, 4, the other is 5, 6. If you roll the die, and why do we roll a die? Because the randomness. I'm trying to contrast as an intellectual exercise randomness, because the efficient market theorists will tell you market motion is random. Okay, but any trader who's ever made any money is halfway successful tells you it's not completely random. In order for you to have a trend, there must be correlation, and correlation is the opposite phenomena of random motion. I am maintaining random behavior is more difficult to come by than order. The whole point of the Sierpinski triangle exercise is if you were to just have a series of die casting, you roll the die 10,000 to 1,000,000 times. Eventually you get a very ordered structure. So you have order arising out of randomness or utter complexity. And I submit financial market structure is the same. That's my long-winded explanation to say that even if I don't have complete information on the future, the data points for which I have confidence often will show you a semblance of the narrative and of the trajectory we can expect. Let me get back to the point. Yeah, your point, whoever brought about the seasonality, is a very important one, and I take that into account. For gold, first resistance, 1115, and second 1140. Good point, Sheth. I'll take your word. I haven't worked it out yet. But yeah, however you worked it out, I'm trying to figure out. I'm trying to acquire a little more confidence that in fact the bottom's in before yeah, that's fairly straightforward for me to figure out. But I'm not sure how you came to those numbers. But certainly we could see those levels. Yeah, that's quite doable. If gold is trading right now at just under 1100, yeah. Oh no, certainly 1115, 1140. We'll see that. We could see that in the run time allotted that between this coming Friday, 2 days from now, and my next projected time point in September, 9/11. Certainly, easily. I'm not again exactly sure, and I haven't done that yet. I just haven't worked out specific price levels, merely because the focus of what I wanted to present today was to show why I think we are trading in the ranges where we are, and what I expect directionally as a narrative trajectory I expect the sectors to travel to. The precision, the actual levels that could serve as overhead resistance if we start to see the markets moving up, I just haven't worked out yet. But I will, because now that, again, I'm in it. I'm partially in it on silver. So I will certainly work it. But those numbers, just off the top of my head, seem quite plausible. I mean, that's easily reachable. Okay. Let me go back, continue here. This is just the daily. This is just the same, showing some levels to which finer scale of motion on the daily silver chart here. And moving on quickly. Geocosmic factor, this is current. Certain planetary aspects or stations of statistically high correspondence to trend reversal in market prices. Okay, Moon in Sagittarius. For those of you who are familiar with what I'm talking about, great. If you aren't, don't worry about it. Suffice it to say, this past Saturday, which was the 25th, and this Sunday, the 26th, and I believe Monday, if I'm not mistaken, but I know for sure Saturday and Sunday, the 25th and the 26th, if not Monday, I just don't have my ephemeris up, but I have a slide. Over 90% of the time when the moon is in Sagittarius, for those of you who understand what I'm talking about, you see major moves in silver. When Mars is in Scorpio, you see 92% of the time over a very large sample, I mean talking about a sample size and length for more than 60 years, you see 92% extreme moves in gold. Now, Moon is in Sagittarius base essentially for the purposes of this presentation right now, even though the moon moves very quickly. It's not technically, it'll be back in about a month or so, basically. Mars is not in Scorpio until the first week of January of 2016. So that's not applicable for gold. Doesn't mean that gold can't move. Doesn't mean that. I'm just saying, I just wanted to point this out. This is one of the reasons silver tends to be more volatile in general for a host of factors than does gold, but this is a relationship that I'm exploiting currently, in part, not solely. I'm not going to place a trade solely on one relationship, but the fact that for all practical purposes we have the moon was in Sagittarius, I think to a large extent is why we had that bottom come in last Friday. That is very definite in my head. I want to hammer that. I don't want to gloss over that too quickly. The fact that we have had this relationship, whether you understand this or not, is not irrelevant. I teach people who are interested in, the celestial cycle and market planetary relationships. If they are interested, if they're not, look at a numerical correlation. This is this to a large extent, if you ask someone that looks at it from a similar view as I do, that's why the market in silver formed that bottom last Friday. On a very deep level, it might have been something came on a more topical level. It could have been a report, that came out Thursday or Friday. It could have been something. But the reason that that particular type of information bubbled to the surface and manifested as a fundamental type of information had to do if you ask someone like me, because of this relationship. It's 90% reliable. Anyway, that's that. I'm merely including the slide to indicate some of the things I look at, any one of which by itself, 90% of the time is going to be insufficient for me to pull the trigger and put money in a position. But in aggregate, when you put all these little bits and pieces and making sure that they're very different, when you see these convergences, you say, okay, at what point do you have enough of a pattern to suggest it passes the thresholds consistent with your objective profit levels, and that's when you have a degree of confidence. I still go on and do my money management, but that's a separate issue. Okay, this is the picture of what I'm referring to. This is a little symbol representing the moon. This little red arrow represents Sagittarius. Go back to the moon in Sagittarius. So this is what was at play. Oh my gosh, you can't, the date, this was yes, a Monday's date. This was the 27th. You don't see it. I don't know how that happened. It somehow, I purposely, that's the important piece of information. I apologize. Somehow this got cropped off. When I was setting this up, it had the date. That's important, but it was for Monday, the 27th, showing this is the relationship. This is just a technical piece of software that shows where planetary positions are. This is the house of this little red thing where the arrow is Sagittarius. And so we're 17 degrees, 11 minutes into that sector as the planets rotate in their orbits. Okay, and that's an important, when that happens, 90% of the time you see a trend reversal in silver prices. And so I think I think, if you ask me on a very deep level, cyclically, is what was an instigator and a promulgator of the move of the bottom forming on the chart in silver a week ago, or not a week ago, last Friday, the 24th. Again, the question in my head is that one and the same as my projection for this Friday, meaning that I was off by a week, or are they two separate data points? I'm not 100% certain. If you ask me right now, I'm expecting, here was a situation that I was here, this is gold. Let me switch to this is a weekly, that this bottom that came in, this is the last week, this little bottom, if you can see it on silver, last Friday, that's this is a weekly chart, that bottom is one and the same as what will be this Friday. I think I was off by a week. Well, we'll know. Next week this time I'll kind of have that more precise certainty as to whether or not that's a correct assessment or wrong. Because it could be that my projection for this Friday is a different data point, in which case more likely it would be a top. in which case I probably should not, I got long prematurely. We shall see. You know, the future provides certainty, you know, and kind of like Monday morning quarterbacking. It is what it is. But that's that relationship. This is just graphically illustrating. This is the picture of the arrangement of correlation that was present this past Monday, and it was from Saturday, Sunday, Monday. The market responded to it the previous trading day, which was that Friday. This little arrow is pointing to that relationship. This is the planet in question. This is the particular what's called house or constellation. When this happens, 92% of the time you see a turn in silver prices. All right, moving on. This is just the weekly chart in gold, longer term wave count. This could be 1, 2, 3. This triangular serpentine type structure, that's a classic fourth. And I submit we are either the bottom that came, this is the July 24 bottom last week. This is intra-week. It's an inside formation thus far. We shall see. We've got 2 and a fraction, whatever time it is today. We've got basically 2 more sessions to see what type of action. Now, action we will see. Inside formations tend to correlate with trend continuation. Curious. So remember from the first slide I was saying, I don't know that this is the, you know, we're not going to see lower prices in the metals before we go up. Again, this is the start of what I call, could be a fourth. This could be the 1. This could be 2 of the 4 of the. This could be 1 of the. This could be 1 of the 5. This could be 2 of the 5. This could be 3 of the 5. Now, from a proportionality standpoint, that's kind of short. That's not a 1.618 extension of that little 1 there, if you know what I mean. Anyway, we'll see. It could be that this is just an internal blip that I'm exploiting, and we're going to move up for a week or 2 or a few sessions, and then move down in what would be the continuance of a third or a fifth of a fifth. Notice here the red line. This is just a completely different topic. Notice the gradual appreciation in commercial net long position. We're just approaching even Steven here. And interesting, as we're approaching that, the small traders, the blue line is they're just kind of heading lower. So the commercial positioning is getting to a point where they're just about to eclipse a net positive, come into the 0 level. They have been net short for so long, and now while the market's been coming down in response to that net commercial position, now I see that the commercial position may be looking to go net long if it continues on the current trajectory. And it looks like the small traders, which get it wrong about 85% of the time, may be looking to go net short. That would add greater confidence that we are at least going to move up at some point. I'm glossing over this because I have said nothing, or insofar as even if what I've just said is true, it doesn't speak to the timing. There is typically a delay, and that complicates that. I'm just pointing this out in terms of an obvious relationship. Whether or not it would manifest, it probably would not manifest immediately, because typically with commercial activity and following price action, there's a delay on the order of months. But it is interesting. Next slide. Same scenario with silver. Now, notice the commercial activity. They're becoming decreasingly net short and approaching the 0, while the small traders, as reflected by the blue line, is getting less and less net long. And if they're converging and crisscross, that would be bullish for metals. Would be. I'm not suggesting it will. It's just if a trend persists based on the inertia of what we see in terms of the varied factions, that would have bullish ramifications for metals. You can see the trend and a plausible wave structure. I will say this lavender line, this open interest, correlated with what we're seeing, is bearish. Rising open interest, falling price, that's reflective of new sellers coming in, serving to continue to offer the price down by itself. Further complicating, you can see in the last few weeks here, just from this little top here through yesterday's trade here, falling price, falling volume. That suggests that the falling price is more likely at an end or near an end. So you've got a myriad of mixture, some things and some whatever relationships you focus on, and however you establish your relative weightings to each one of these relationships, ultimately, and it will work us towards a net resolution of what we expect to see in the price. All right. Let's see, any questions at this juncture given that? All right, so far so good. Just an intermarket connection situation. I'm not going to go into detail on the varied complexities, but this is a standard set. Here, rising dollar, falling commodities. Falling dollar, rising commodities. There has been in the last year a kind of, as represented by various commodity indices, Goldman Sachs commodity index, CRB indices, falling commodity prices, rising dollar. So this relationship more or less between the US currency and commodities in general worldwide has held. Okay, so thus the next slide, this is the dollar index, US dollar index. You can see, and then notice here, rising dollar. So the question that I thought about last night when I said it might be helpful to indirectly, peripherally kind of figure out and project and gain some insight as to how I can expect metals to move based on the response of the dollar. Again, going back to the previous slide, dollar falls, I can expect commodities in general, of which the metals, gold and silver, are a subset, to appreciate, find support, and move up. If the dollar continues to rise, I expect further pressure on commodities, of which gold and silver are a subset. So, to the extent I can forecast or have some indication and projection that is reliable for the dollar, indirectly that allows me as a proxy to kind of figure out what I can expect in metals. So the big and obvious question is this top the main top? Did this top that has already come in the US dollar, is it the end of the bull market and everything we've seen since? Is it just a start of a new bear market, or is everything from this top through where we are right now just a temporary pullback or retracement, but we are still in a generic bull market in the US dollar? I don't know. I don't have the answer. I have some ideas. Look at the commercial activity here on the red line for the US dollar. For going back for years, this was the weekly continuation chart. So going back 4 years at least to 2011, overall trend in dollar is strength. And we look at, we consider that in the context of what's going on with other important pairs, currency pairs in the world. You know, the euro, Asia, the Japanese yen, Chinese yuan is becoming more of central importance, you know, and all the major currencies, the British pound, all the major world currencies. We don't look at it just in taking into account what's going on with our domestic economy. If I'm thinking about this fundamentally, I want to take into account in a broader context of what's going on worldwide, certainly as a currency. But certainly here's an obvious trend that is developing, an increasing rather, of the net short position on the part of the commercial activity in dollars. So what does that tell me? If in a very broad sense, it suggests that commercial, the sector of the volume that's about at least 70% of accounting for the volume of the dollar, is bearish. I don't know if they're, to what extent and why and so forth. All I can see is from the changing pattern of commercial activity, commercials at large are getting more and more bearish on the US currency. That doesn't mean we can't go up and test this top again and even take it out. It just means I'm just showing. Also, I see, now that's bearish. The fact that while the market, after we hit the top, has declined in price and also declining open interest, that's somewhat bullish. That's telling me that the reason the dollar has depreciated is, the longs were getting out. They were covering their longs. How do I cover my long? I sell. The selling pressure is served to, in part at least, offer the price of dollar down, nominal price of dollars down. So that's saying that phenomena tends to dry up pretty quickly. It's a transitory phenomena, versus if while the price had declined off of this top in dollar values, been accompanied by rising open interest, that's new sellers coming in, which tends to be a more prolonged, persistent phenomena. So we've got a mixed bag of data. I don't have the answer. I'm trying to see structure, and are we going to form a head and shoulders here? I will say this. Again, going back to the interplay between the IMF, Christine Lagarde, and her relationship with Janet Yellen at our central bank, our Fed being the primary bank on earth right now, I expect, my guesstimate is that we're going to delay, we won't raise interest rates until 2016. I'm not quite certain how varying sectors, be it our currency, our stock market, the bonds, the 30-year treasury, and in turn, precious metals are going to respond to that. We saw today, again, a knee-jerk response. Stocks rallied on the indication that just words, some verbiage out of, the minutes read of the FOMC meeting in Washington, D.C. about the possibility, just an intimation that they may, now we're seeing some data that might suggest some strength embedded in the labor market, and as such, sooner rather than later. The last I read, to kind of put a number on this and make it a little more tangible and quantitative, is that the major dealers are pricing in at about a 40% probability that the Fed will raise rates in September. So that's 60% chance that they won't. Okay, 60-40 for a rate hike. If they raise rates, I guess the stock market is thinking down the line, saying, well, raising interest rates will help bolster the middle class because, savings accounts in deposits, saving a certain class of money, I forgot what it's called, but certain segment of money in circulation will be appreciating at a higher rate. What we've got to find out, even if at whatever point they raise rates, what's the amount and to what extent, do they have a regime of continued rates as we move through into next year, if so. But my guess, the US dollar can be expected to, if we raise rates, the knee-jerk response is that the dollar would go up. And as such, that would I would think there would be an opposite response to, strengthening dollar, depreciation in metals. That's where I'm going with this. That's the inner market. Again, vis-a-vis the preceding relationship that's standard. If we take away, complicating elements about deflation or inflation or other factors, price of oil, et cetera, and whatever other variables serve to complicate this. Okay, so if we have a further delay in interest rate hike on the part of our central bank, let's just say, until 2016, we may see a little bit of drift lower into, by the dollar, and that could support metals prices. At which point, but up until whatever point it is, what could be considered by the financial sector to be a significant hike in rates, all right, then we would see pressure on metals, and that, then we would see the dollar increase, and that would put pressure on metals. Yeah, so I'm just trying to point out a possible correlation here. Let's see if we have another point. We are not going to be party pooper. Yeah, exactly. I agree. Yeah. So it's very difficult. You're bringing up kind of the political aspect of this. To what extent is the bank working in concert with the present administration? And for those of you, just to go off on an appropriate tangent, those of you are, and I talk to people all the time, gloom and doom, and we're heading, we've got the $18 trillion deficit, and to what extent, if at all, we can address that. What do we got to do? I have my own thoughts on that, infrastructure having nothing to do with my trading activity. Here's the thing. I heard there was a guy, was it Peter Kiernan, said we need to set up, and this gets, just for the good of our nation state, the sovereignty of our land, we should probably set up a separate bank, an infrastructure bank, to induce and stimulate the labor force. The big area infrastructure, the entire national infrastructure, the global infrastructure, but just limiting it into the U.S., made a very good point. We set up a super fund. We fund a bank, the sole purpose of which is to stimulate, what they call ready now or shovel-ready infrastructural jobs. We train the workforce. It's a $1 trillion funding project, and you stimulate the economy, and then that way we can. I'm getting off topic here, but we can improve the job numbers and allow the Fed to go ahead and make that rate hike so as to increase savings appreciation, and maybe provide some type of, even if it's only lip service to the middle class. Yeah, because that's the problem fundamentally here, or an issue here. I don't mean to get off on that, but metal prices are going to resonate and revolve and respond to these types of forces. So all of these kinds of issues are sensitive and create motion in the markets that I'm talking about today. Anyway, that's the dollar index. Final slide, folks. I don't want to get too far off topic here. This is just a directional. This is silver. I should have put a title here, but if you can see silver, that's the September contract. This is the bottom. Okay, at least the prices came out on that. These are just an overlay that I said. This is 61.8 of, if this is kind of like 1, 2, oh no, this is 1, 2, this would be 3, this would be 4, and then your fifth wave would bring you down to the $14 area, assuming fifth waves often are truncated. We only, this is this bottom here, the lowest point on your screen right here, if you can see that, coming right down into the 50% fib level that I put on the screen as a Fibonacci extension. That's last Friday's bottom. And we've been going up through today. This is I printed this chart out just literally about less than 2 hours ago. All right, so this is showing the recent price action. The last quote I have for silver, 1477. The high for today was 1490. So we're just under $15 area silver, $15 per ounce, 1477. I got long yesterday at 1437 or 1430 on average, varying prices roughly. So we're up a little bit. Based on my expectation, again, this bottom last Friday, I believe, came in part due to that planetary cyclical, the moon in Sagittarius. 92% of the time you see it correlates with trend reversals. This is an ADX oscillator, just a directional signal tool that I sometimes use to see whether or not it agrees or disagrees. It confirms or is providing kind of contrary indication. We got a buy signal by virtue of this green line crossing up above the red. Back here on this day, I should have. That was curiously, if you had taken that signal explicitly and got long, you would have either been. I can see it was trying to project this bottom right here. It was very close. Well, let's see. It was very close. Well, no, you would have had to sit through. Either you would have been stopped out for a loss, or you sat through some extreme drawdown there. This is the buy signal right here, kind of right on this grid line here, on the 22nd of June. So you can see what happened since then when this indicator gave a buy signal in silver. In that case, it was not all that precise. But this is not quite a buy signal here. That wasn't good either. But in any case, the reason I showed this is the last time this particular indicator, it's an ADX, gave its current signal is a buy. So it's telling me it's in concert with some of the other relationships that I've examined suggesting go long in silver. It's not, we have not yet had a sell signal. The next time you get a sell signal is if this kind of brown purple line crosses up above the green, if and when that happens. Unless and until that happens, this particular indicator is saying we should be long in silver, which we are, consistent with the data points that I have some confidence in currently. Okay. And folks, that does it for today. I have time. I probably went over. Let me check my time. Yeah, I'm 20 minutes beyond. But again, just as a final note, if you have questions more precisely that I'm not going to be able to answer before we complete today's presentation, call our office, Pacific Trading Academy, 800-339-8588. Peter Newman is the head of admission, and he can tell you in more detail arrangements about our programs. You can also access the website again, www.pacifictradingacademy.com. So with that information, let's just see. Any questions, guys? Again, as a quick synopsis, I expect prices in gold and silver to appreciate between now and my next projected time target, again, September 11. After that, round and round she goes. Where she ends up, nobody knows. But we will, as we get closer and closer, and with each passing moment and hour and day with new price action and return traced out on our screen, we're able to more precisely assess how we, and adjust the projected states of motion and adjust our current positions accordingly and make new ones when we see a reasonable degree of edge. Let's see, any other questions? Okay, thank you. Thank you, VJ. Thank you, Sheth. Excellent. I'll leave it there. I guess no more questions. Again, if you'd like, we have recorded today's presentation, and if you'd like more details on what we do, or what I do in particular, each mentor, I have, my coworkers, some of you know them, Henny Labib, Mike Bridges, Ken Chow, and myself. We all have different methods and different ideas. Some ideas we tend to agree, other things We see it differently based on our research and our experience and our analyses and varying models that we use, and this is what makes a market. So it's always good to kind of have a interplay and a back and forth of thought, especially when it comes to systems as complicated in these. So again, if there's anything I can do to further, in a more explicit way, indicate how I do my analysis and how I come up with the ideas that I do, at least you can talk to Peter Newman at the head of admissions, and sometimes he arranges contact calls for us. If any of you are interested in working with us, we have tutorial programs, and I've been mentoring and teaching and consulting for, again, 15 years. I've been trading for close to 35 years now. So again, it's been wonderful, and probably in the next few weeks we'll do another presentation either on a related or something that is heating up at that time. Until that time, I wish you all profitable trading, and have a great day. Talk to you soon. Bye-bye.